Charles, thank you for that kind introduction. And Myron, I've got my funeral garb on today. I'm a little self-conscious now about what I'm wearing, but I will say this at the beginning. There's nothing sad about what I'm about to talk about. In fact, I think the fact that there's so many people here reflects not only the importance of the issues, but the growing movement that's out there to really get our arms around corporate governance. And that's what I want to talk about. But it shouldn't go unnoticed or unacknowledged the role that this center has in that. For a long time, you were basically the lone voice on some of these issues, certainly coming out of the academic side where the real research is happening. You've been at the vanguard, not to use the pun, of all this, and that's been very important. So we thank you for all the center does. We thank the University of Delaware for making this available to us. So what I want to really talk about today is how we think about the long term. The title of the speech is actually well chosen. Long-term value begins at the board, the power and potential of active asset stewardship. And I think that's really what we're all here to think about and to talk about and to discuss further. This is not something that we ought to be thinking about, and it's certainly not something that we at State Street think about off the side of our desk. We think this is actually an existential issue for capitalism and how we think about capitalism going forward. So I'm really going to talk about too many things. I'm going to talk about basically 4 or 5 points that I want to make today. Firstly, that the pressures of short-termism and the challenges and forces that promote short-termism are really having an impact on the long term, and that's what we need to think about. Second is why we believe that asset managers like us have a real role in changing that. Third is the point that Charles was just talking about and what John Weinberg had always spoken about. It's the important role that effective, independent, and diverse board leadership can play in focusing companies on the long term. Fourth, how to think about how we think about corporate governance much more broadly today and how it needs to incorporate environmental and social sustainability issues. And last, I'm going to close with the need for partnership, that no one of us can do it alone here, and that it's only, in fact, when that partnership starts to happen that we'll start to see an impact. So let me begin, and let me talk a little bit about short term. I think it's very important to understand that the deck is basically stacked against the long term. There are just tremendous pressures out there, not just in the financial world, but in our lives. I mean, certainly we're here to talk about financial markets, but think about it. Everything from globalism to technology has created an on-demand expectation. We all expect everything today, right? Who would have thought that we're going to be seriously not just talking about, but witnessing drones deliver packages hours after you've ordered it? It will happen, and that will create an expectation. And it's great in many ways, but it's created a mindset of access and get it done and results maybe fast, and if it doesn't happen, then it must not be right. And that's not always that great. I mean, if you think about it, it's creating a short-termism in almost everything we do, particularly in business and markets. And if you think about it, it's probably not a surprise. So many of the orientations, biases, and incentives in business and in capital markets are actually very short-term. Think about it. Public companies report quarterly, or in some countries, semi-annually. Investment vehicles are increasingly valued daily or monthly. Vanguard and us are leaders in ETFs. Those values get struck with every trade. And people are focused on what's that thing worth, not today, but what's that thing worth right now. But perhaps the heaviest finger on the side of short-termism is management. There's annual bonuses that comprise a very significant part of compensation, and even so-called long-term bonuses are often set as a result of the performance that just happened in the past year. Think about CEO tenure. In the U.S. now, that's 5 years. That's hardly enough time to drive change. Any of you here that are running businesses or running business units or even running something like this center know that things don't happen in that short a time frame. And there's lots of pressures on senior management. A recent study found that 80% of CFOs at large U.S. companies said they would sacrifice economic value for the firm to meet the quarter's earning expectations. So I don't know what's more surprising to me about that, the fact that 80% do it or that 80% admitted that they do it. And then there's now boards. Boards typically are viewed as, okay, this is the bulwark against it. But even boards are under tremendous pressure to keep the stock up. Indeed, the topic du jour amongst boards these days is the role of activists. And while activists can be short-term oriented and may try to maximize the stock price, but we can't really blame it all on them. Boards are responsible for overseeing a firm's long-term strategy. But in many cases, they're comprised of directors who lack the expertise, the scope, the diverse views and backgrounds, or even the time to effectively do that. And it's important as these governance issues are, and there is certainly, if you look around the room and think about the conversations you've had in your own boards about this, talking about governance, it's not just there. It's environmental and sustainability issues. And these aren't happening at the board level as much as I think we'd all like. So from climate change impact, water and waste management, supply chain management and safety issues, too often companies are not focused on these long-term risks to their strategy and their long-term viability. So ESG issues, such as long-term governance, are important, but they're not getting what they need, again, because of this short-termism. Secondly, so then why do we care about this? We're money managers, right? We're here to give us your money. Hopefully we'll provide you a return. If we're an active manager, we'll provide you some alpha. And why shouldn't we be limited to that? Well, the way we think about it, and I know Vanguard thinks that way too, and many of our colleagues, our mission is to invest responsibly to promote economic prosperity and social progress. By definition, that's a long-term mission. We do that by helping clients achieve their investment goals, whether it's saving for retirement, which would be typical, helping an endowment or foundation fund something like this for research and innovation, or building infrastructure for tomorrow. These desired outcomes, if you think about it, by definition are long-term in nature. There's very, very little that we do in an investment firm that is truly about the short term. The desired outcome, and by the way, the desired outcome is not some particular return. The desired outcome is to fund some kind of liability, retirement or otherwise. Those are long-term. And indeed, we think about our fiduciary responsibility is to ensure that we're maximizing the probability of attractive long-term returns on our clients' behalf. So we do that primarily and firstly by building capabilities. Right? So anybody that's in a money management firm, the first thing they're doing is saying, what is it that I can build that's distinctive that will not only ensure those outcomes, but do it better than the next fellow? But after creating those capabilities, that's only the beginning. Once our clients invest in our strategies, they also own these underlying companies. And we believe our responsibility to our clients extends to that stewardship of assets. And as Charles noted, as passive managers, that is particularly important because an index fund, if you think about it in the public markets, is probably the closest thing to permanent capital that we have today. Unlike an active manager, we can't walk away from the investment. So if I'm very upset with some large American company, I can't overnight turn the S&P 500 into the S&P 499, right? We're stuck with them. So again, to quote Jack Bogle, who we all admire, if you're an active manager and you don't like what the company is doing, you sell it. If you're an index manager, you try to fix it. That leads to what Charles has talked about, is this engagement with companies. We share our views on risk and opportunities that we believe will affect returns over the long run. So how does that actually happen? Well, each year our team identifies specific issues that will impact value over the long term and issue guidance to companies on how we think about addressing those areas. And this is a very important point here. We're not smart enough, we don't have the capacity for any given company to say, thou shalt do this. But we have seen enough, and since we own these underlying companies across the index, that we can help generate principles and guidance. And so that's what we do. Through this patient and consistent engagement, using our voice and our vote, we seek to promote positive change. And that's what we think asset stewardship is. It goes hand in hand with good corporate governance. And the hallmark of our approach is not passive inaction or adversarial interaction, but active, transparent engagement. Again, we always get pushed, why aren't you more adversarial? Well, again, it's a reminder that we're going to be there today, we're going to be there tomorrow, we're going to be there as long as the company's in the index. So we'd much rather work closely with management as opposed to in an adversarial way. If we have to, we will, but we try and create a two-way conversation that generates light, not heat, on different perspectives. So what do we focus these engagements on? First and foremost is board leadership. And I actually didn't know that that was John Weinberg's fundamental thinking, but it's almost like we're quoting him on this. Having myself served on a number of public, not-for-profit, and mutual fund boards over the years, I and the rest of my team believe that effective, independent, and diverse board leadership is a precondition for ensuring that companies are focused on the long term and doing what I said before, increasing that probability of attractive long-term returns. This board, and this kind of board too, is probably, we believe, the most effective counterweight to the short-term pressures that I described earlier. By effective, what do we mean? It's having the right skills. And not that all those skills have to be in each board member, but across the board, having the right skills. By independent, we mean a board that is not captured by management, that has the ability to exert its oversight and influence in decision-making, independent of what management may want or desire. And by diverse, we mean with skills, experience, and diversity of thought necessary to provide a broad perspective. The board is responsible for overseeing a company's long-term strategy. They do that on behalf of shareholders. The board is the one assessing management's performance, ensuring board effectiveness, and providing a voice independent from management that is accountable directly to investors. They ask important questions like, is the company meeting its milestone and exceeding its benchmarks? What will emerging challenges and disruptions be? From where will innovation emerge? And is management executing as well as possible given the company's stated objective, not just for the next year, but for the next 5, 10, and even 20 years. Now, the good news is, and I think others would share this, boards have come a long way and have gotten a lot better. And that's part of my optimism today. When I look around at boards in a very short period of time, I mean, it's been a long-term trend, but certainly since the financial crisis, you've seen, I think, a systematic upgrading of boards. Today, they're more actively involved in setting strategy, mitigating risk, and thanks to partners like the Weinberg Centers, they're getting better guidance on ethical and governance issues. In fact, the data show that there has been a positive shift toward more independent leadership on corporate boards since 2008. But still, in 2016, there are significant gaps. So nearly a quarter of the S&P 500 companies and more than a third of the Russell 3000 companies have no independent leadership structure. And I'm not saying separation of the board chair and CEO. I'm talking about any kind of independent leadership structure. In Europe, the case is even worse. So notwithstanding their important role, we see a number of challenges at the board level that are preventing more companies from achieving their potential. Perhaps the biggest, and there's many in this room that have faced this personally, is the fact that the urgent triumphs over the important. In any board meeting, there's pressing business and regulatory issues that have to come first, leaving long-term strategy and focus to fall to the bottom of the corporate agenda and therefore moved on to the next board meeting. How many of you have served on a board, right, where strategy gets relegated to the annual board retreat? You know, I don't know about you, but for me, if I only thought about strategy once a year, the firm would be in a whole lot less better position than it is now, and I think all of you would say the same. So asset stewardship, we believe, can go a long way towards helping a board reprioritize the struggles that they're having with these issues. That's why we've made effective independent board leadership the key central element of our corporate governance engagement program, providing specific guidance on governance structures that enhance effectiveness from the selection process to the tenure of the position to performance evaluation of the board in succession. Now, as I said earlier, clearly there's 9,000 underlying companies in our various investment portfolios. We don't engage with each. Rocky is very good. She's not that good. However, we have regular interaction with large companies as well as select sectors and companies with particular issues. What the team does is certainly focus on those companies that we think need some kind of focus, going through some kind of crisis, whatever that may be. But over time, working sector by sector to be able to put out guidance that has broader application beyond those companies that we're having interaction with. And the goal of these efforts is to ensure that boards and individual members of our portfolio companies are skilled in independence. One of the big flashpoints in this debate has been what I referred to earlier, the separate CEO and board chairman roles. Personally, we think there's too much focus on that. We think the focus ought to be on this independent leadership structure, but this litmus test of whether or not there's separation. In fact, I can point to you many companies that have separated that aren't very good and don't have a good independent leadership structure, and those that haven't, then in fact through lead directors and other things that have done well. So the point here is we don't deal in litmus tests. What we're trying to do is get these principles out there and see that they're being adhered to and followed by these by the boards. We also expect boards to protect the interests of long-term shareholders when activist investors appear on the scene. Now, let me be clear, as there's some activist investors here in the room, and they know me well and know that, in fact, I think more times than not, the interest of the long-term shareholder and the activist investor are aligned. So this isn't about that activists aren't good, but we do worry sometimes about some of the settlements that happen. If you look at what's going on now, very few of these now go to any kind of proxy fight or proxy contest. There's some kind of quick settlement. And our view on that is let's just make sure that it's great that that was done quickly. It's great that that was done without squandering corporate resources in a long proxy battle where only the lawyers are going to come out ahead. But we want to make sure that in this settlement, of the interest of the long-term in place, what's the implication for the long-term strategy? What's the implication for capital allocation? What's the implication for corporate governance structures? So that's why we've told boards, or suggested to boards in our guidance, that they need to consider the interests of long-term shareholders in these settlements with activists as they assess everything from the duration of the agreements and ownership thresholds over this holding period. They also need to consider when engaging and when activists are involved is what's the risk to the company's share price posed by the lack of board oversight on significant pledging activities by their activists. But again, I use this just as an illustration that in many cases, there's actually a lot of alignment between the short term and the long term. You just need to go that extra step and make sure that the long-term interests are looked after. Now, we know that remedies such as board refreshment improve effectiveness and independence, but what about diversity? We think boards, in fact, the evidence shows that boards that embrace a broader range of perspectives are more likely to avoid groupthink and achieve better outcomes. While we believe in and support broad board diversity in principle, we have especially focused on gender diversity for a simple reason. There's great research out there. The empirical evidence is quite clear. For example, a report by the Conference Board in January suggested that this outperformance is largely attributable to the new perspectives women bring. Notwithstanding this growing evidence, there are painfully few women serving on corporate boards. A quarter of Russell 3000 companies don't have a single woman on their board. And for the 60% that do, it's usually 15% or less. And it's not only at the board level where gender diversity matters. Evidence is also mounting that shows companies with higher levels of gender diversity in top management and senior management outperform companies with less diversity. In fact, it was that research and our collaboration with CalSTRS, which I know there's some representative of CalSTRS here, was the basis for a proprietary gender diversity index we created last year with CalSTRS and the ETF that tracks it. It has the appropriate ticker symbol, SHE. This index is composed of the largest U.S. companies that have the highest levels of women in leadership positions, boards, top management, and senior management, relative to other firms in their sector. SHE was one of the most successful ETFs launched in 2016 in terms of assets under management. So, in other words, rather than wait for companies to take action themselves, the index and SHE allows investors to use their capital to influence corporate behavior, if you will, some kind of positive screen. And the underlying index creates a standard that all companies can aspire to. And in fact, that's what we tried to do in putting this together with CalSTRS. And CalSTRS really pushed our thinking on this, that it wasn't just about the ETF, but it was about the index itself. Companies would aspire to be part of that, and that's been very true. We reconstitute the index a couple of times a year. Companies know when we're reconstituting the index, and are coming to us saying, are we qualifying, are we qualifying? They're quantitative standards, so it's not like lobbying me is going to make them any better. It's about actually doing something, but the point being is that it's something that companies can aspire to. So today, on the eve of International Women's Day, and to mark the one-year anniversary of SHE, we're calling on more than 3,500 companies we invest in the U.S., the U.K., and Australia to increase the number of women on boards. We're issuing guidance shortly to help them go about doing this. And again, these principles are based on research showing the need for boards to expand the search of candidates beyond existing director networks and to address sources of unconscious bias that might inhibit the recruitment of women. In addition, I have something else to share on this eve of International Women's Day. So if I can bring up the slide. I think you all recognize this, don't you? It was over 25 years ago that early one December morning, the famous Charging Bulls bronze sculpture was actually erected not here, but on Wall Street in front of the New York Stock Exchange. The sculptor, Arturo Di Modica, wanted the bull to celebrate the can-do spirit of America and Americans' determination to work hard and be successful. The bull was actually removed the very day it was installed, but there was a groundswell of support from New Yorkers, and then Mayor Ed Koch and the Bowling Green Association found a permanent home for him at the Bowling Green Park nearby where he stands today. Well, today we're giving him a new counterpart. This actually was revealed this morning. She is a daring and confident girl symbolizing the can-do spirit of women who are taking charge today and inspiring the next generation of leaders. She stands as a reminder to corporations across the globe that having more women in leadership positions contributes to overall performance and strengthens our economy. Now, this is just a mock-up, and the real one was actually placed there a few hours ago. You can see the real photos live during the day, and again, in the spirit of social media, hashtag #SheMakesADifference on Twitter. You'll start to see what's out there. The point of all this is, it's a great gimmick, and it'll be there for a week. But the point is that there's evidence that this makes a difference. And I think it's incumbent upon all of us in the room to do what we can to make that difference happen. So the broader point here is that a long-term horizon, if you've got a long-term horizon, you need to focus on beyond those goals that typically you're focused on for the short term. And for us, as we've started to move and get some impact in the areas of governance, we've now moved beyond governance, again, not to leave it behind, but in addition to governance, to focus on sustainability issues. Sustainability issues are both environmental and social in nature, and they're increasingly seen as drivers of long-term value and better outcomes for companies. And boards have a big role to play here and are often better equipped than day-to-day management to make sure these issues are looked after over the long term. As all of you know, environmental and social sustainability issues encompass a broad range of topics, from climate change, water and waste management, supply chain management, workforce diversity, and talent development. And we see the evidence that these issues are becoming more and more important all the time. Just think about the last year. Think about the corporate scandals that we've seen over the last couple of years. What have they been about? Auto emissions, food safety, labor issues. These points, these topics emphasize the need for companies to assess the impact of ESG risk. And in fact, the World Economic Forum has every year, if you look at their risk map, their risk heat map, of the 10 global risks that they put out there, 70% of them are associated with some kind of environmental or social risk. And it's not surprising, perhaps, that climate change features largely here as we continue to see very high annual temperature records. All of this is to say that sustainability matters. Now, clearly, if we don't have the answers on corporate governance for any particular company, we certainly don't have the answers for a particular company on what they should be doing specifically in sustainability. But that's kind of the point. The range of outcomes that can happen is greater than that will happen. And those of you that investors know, that is the definition of risk. And that's why we believe that boards must incorporate ESG factors into the board's oversight of risk. As ESG becomes a more mainstream risk factor, investing strategy, and contributor to talent acquisition, it is changing how we think about governance in our stewardship activities. Since 2013, we have had more than 2,000 engagements on ESG issues, with over 1,200 companies in our global portfolio on a broad variety of issues. So, for example, in one of the sector projects that I referred to earlier on oil and gas companies, we explored with them on how they're navigating the challenges of falling crude oil prices, geopolitical risk, climate change, and emissions reductions. Talks with a Taiwanese packaged food company centered on monitoring food safety within its supply chains. Meeting with a garment sector company that has a truly global supply chain focused on labor and fire safety standards that can be improved. And after a multi-year engagement with various companies on environmental standards, we've seen, and our colleagues who operate in this marketplace have seen, real improvements in the quality and transparency of reporting around hydraulic fracking, water and waste management practices. As we've engaged with companies on these issues over the years, we've seen the good, the bad, and the ugly of how companies are or are not considering ESG impact. That's especially true after our votes in 2016 supporting shareholder resolutions on climate change initiatives that set us apart from the industry. Now, again, I want to be clear and I want to emphasize this. It's not about us imposing our values or our morals. We believe that these kinds of issues pose both threats and opportunities to companies. And like any other factor like that, it's something that the board needs to be dealing with and needs to be addressing. So it's been our belief that these issues have a long-term impact on the health of companies in our portfolio, and as such, that boards and management need to assess them as they would any other kind of risk. And we believe that asset stewardship can help companies get out ahead of these issues. So as we've spoken out about these issues, boards have asked us for guidance on them, tell us what to do. And again, us knowing and having enough humility to know that we can't tell a particular company what to do, but we did feel that we could put out some principles. So we did so at the beginning of 2017. And there's really 6 basic points here, questions, if you will, for boards to ask themselves. First, has the company even identified material and environmental and social sustainability issues relevant to its business? Not that it will be a risk to the business, not that it will be positive or negative, but has it even done that inventory? Second, once identified, has the company done the work to assess the implications of these factors and, if necessary and where necessary, incorporating them into their long-term strategy? Third, does the company consider long-term sustainability trends in its capital allocation decisions? Are they spending money on it? So you can't get to 1 and 2 and not do 3, right? If you believe that something's relevant out there, what are you doing about allocating capital to it? Fourth, do they have the right people with the right skills to evaluate and monitor these issues, both within management and on the boards? Fifth, are companies tracking and measuring performance in this area? Are they incorporating key sustainability drivers into performance evaluation, compensation programs, and are they including specific performance indicators? And finally, and maybe most importantly, is the company adequately communicating its approach to sustainability issues and its influence on strategy to shareholders and other key stakeholders? What you should take from these questions is that we're intently focused on the process here. Again, it goes back to we don't know the answers. Boards do, management do, or they should. And are they undertaking a process that's apparent to shareholders, that shareholders can take comfort that, yes, this company is thinking about these issues? So as we think more and more companies will focus on these issues, and we think this will lead to improvement on how ESG issues are considered from a business perspective. And again, our preferred approach is not confrontational. In fact, it's through active dialogue with company and board leadership. However, in the event that companies fail to take action, we will vote. People that know us know that we voted. Our proxy record stands for itself. And notwithstanding their important role, this shouldn't all fall on the board's shoulders. We, investors, asset owners, and other stakeholders, all of us in this room, have a part to play in making corporate governance in these sustainability issues part of how they think about investing in boards or whatever kind of engagement they have with companies. And that's why in January, we worked with others to help launch a set of comprehensive stewardship and governance principles as part of the Investor Stewardship Group, which is a collective of large U.S.-based institutional managers and global asset managers. This also includes very important asset owners. We took a leading role with the ISG, which is the first time that both asset managers and asset owners have collaborated and signed on to a common set of principles. These principles, which we urge you to look at, they're on the website here, encourage all investors to become active owners and engage with companies in their portfolios across all relevant ESG issues. Perhaps most importantly, what ISG did, and I thought this was quite creative, they require anybody that signs on to work with others. Once you sign on, you need to become the missionary to help others do it. And that's working. That's getting more and more people. And the reason why this is important, you know, as we've noted, Vanguard's in the room, State Street's in the room, we still only represent a fraction of the $68 trillion in assets under management that's out there. So that tells me, and that tells us, that there's more and more for our fellow investors to do in terms of using their voices and votes alike so that we can make corporate governance the priority that it should be. So in my closing here, what I really want to talk about is this importance of leadership on these issues. As institutional investors, we can encourage businesses to be on the leading edge when it comes to long-term value creation, or we can just sit to the side and be behind the curve. We can either do the minimum for our clients, or we can have a heightened fiduciary responsibility to the millions of individuals who entrust their financial futures to us through retirement plans, endowments, foundations, etc. As I said earlier, they're thinking about the long term. Are we adequately thinking about the long term on their behalf? So it's our belief that by being active stewards of the assets we hold, and that by pushing boards and our portfolio companies to put a premium on diversity, sustainability, and long-term value creation, we can enable economic prosperity, we can advance social progress, and we can create the future that investors want to be part of and want to invest in. So we look forward to working with the Weinberg Center in the future, and thanks very much for your time.